If you think you're making a good investment by buying Treasury bills, here's a question. Are investors literally giving away their money for free? Treasury bills sold at an interest rate of 0 since the financial crisis topped $1 trillion this summer and grew again this week with auctions for 3-month and 1-month T-bills. Why do investors feel they have no option and they just want to park their money there? Joining me now, Greg Valliere. He's Horizon Investments Chief Strategist, along with Stephen Wieting. He's Citi Private Bank Global Chief Investment Strategist. Greg, it doesn't seem to make a lot of sense, but is that how worried investors are, that they'll simply say, here, 0%, I can just park my money there?
I think you're right, Liz. Great to see you. I think that there's so much anxiety. Could there be a debt ceiling crisis? Could there be a government shutdown? Has the economy hit a pothole? With all this anxiety, yeah, it makes sense that people are willing to invest with virtually no return.
I suppose parking it under the mattress is not an option, Stephen. I mean, no. There are other options, Stephen. Buying into a stock that maybe has a 3% dividend yield.
Sure.
I hesitate to say Walmart. We were talking about it yesterday. It tanked, but it's cheaper today than it was yesterday and the day before.
Well, just bear in mind what you just said about T-bills. I mean, this is an institutional issue. The liquidity buffers that institutional investors are required to have. You could take a look at, many institutions can't hold stacks of green paper. And this is the substantial issue while the federal funds rate is 0. This is not something that many individual investors go after.
Okay, so then when we talk about treasuries, though, is that your recommendation, Stephen, that money is placed better somewhere else and not in 0% return treasuries?
Well, I keep in mind we're neutral weight on long U.S. treasuries, 10 years, 30 years. These sorts of yields, in terms of safe havens around the world, are among the highest yields that investors anywhere in the world can find. It's not appealing as a standalone asset. But if you look back to the 10% correction we had in October, for example, of last year, you had a 10% return in 30-year debt over the same period. So it is a risk hedge. It has some value in a portfolio. We're otherwise underweight most debt in the world and generally overweight equities.
Greg, the uncertainty and indecisiveness, some of it is really pushed, whether it's intentional, by the Federal Reserve. Today, you had Bill Dudley of the New York Fed coming out and saying, I still believe that unless we get horrific U.S. data, those weren't his words, those are mine, but if we get decent data between now and the end of the year, we should see a rate tightening this year. But are they just saying that? What's your assessment with your expertise, Greg?
It's just maddening. It's like you maybe want to take Dramamine. Up, down, we might tighten, we might not tighten. I think the Fed has done a terrible job of communicating, and I'm usually a defender of the Fed, but I think they've confused people by saying one thing one day and then another number comes out. So I think this endless debate over will they, won't they, where we overanalyze every economic number, this is going to continue at least until mid-December, maybe longer, and I think the Fed is actually a negative in this story because it's not clear.
Do you think, Stephen, that Congress pushes it to the last second about this debt ceiling situation? And again, 4 p.m. Eastern, you're going to get a lot more clarity, we hope, from Treasury Secretary Jack Lew. That's when we have our exclusive sit-down. But you on Wall Street have a different opinion of hitting the debt ceiling. In the past, most of you guys that I've interviewed say, let's grow up here and let's not fool around with this and sabotage our own country. Is that how you feel? Because there are others who say, wait a minute, we've got to find religion when it comes to being a little more fiscally responsible.
Well, it's been the modus operandi to run up until the last possible second, and markets will view a U.S. default, whether it's obligations, whether it's prioritizing interest payments or what have you, as a potential real financial disaster, something that would provide huge restraint on the U.S. economy, even if there were no technical default, even over a short period. So markets generally don't believe it will happen, and they've been proven right. I think that it's just very important to note that whatever the politics and whatever is needed fiscally, you have to keep credibility for U.S. debt integrity.
Well, we got to keep credibility because the closing bell's about to ring. Greg Valliere and Stephen Wieting, thank you so much.